Typical financing structure. There are several ways to value a business, and you can learn more and in greater detail in my buyer program at businessbuyeradvantage.com. But basically, there's the replacement value, what the stuff is worth that's there in the business. There's the market value, what's the value of this business based on what others have paid for similar businesses. And the investment value, what is the value based on the required rate of return on my time and or cash investment. Whatever you do to come up with a price, you're going to end up negotiating with the seller to achieve the price at which both of you are agreeable. Let's say it's $250,000 in this example. You also need to know the replacement value or the value of the tangible equipment and operating capital assets, things like inventory and receivables. It's the tangibles and operating capital items that we're going to be able to offer as collateral to a bank for a loan. So in our example business, let's assume the following things: that there's some equipment with a fair market value of $100,000, that the inventory on hand is usually about $50,000, and receivables are usually about $20,000 net of payables. You need some money to finance customers over and above what your suppliers are willing to finance you. So you go to your bank and discover that the banker will lend you 75% of the equipment's value, 50% of the inventory value, and 75% of the receivables value. The equipment will be financed as a term loan amortized over 5 years, and the other credit will be a line of credit which revolves. You don't ever have to pay it off, you just have to make interest payments. This means we'll get a term loan of $75,000, a line of credit of $25,000 for inventory, and $15,000 for receivables. This means we have $115,000 of bank loans for our $250,000 business purchase. We refer to bank loans sometimes as institutional money or lenders. So now we need another $135,000 to get to our $250,000 purchase. In most small business purchases, the vendor is often required to lend the money to the buyer, some of it anyway. This is called a vendor take-back or seller financing or some other similar term. In my experience, businesses with a good deal of capital equipment can often expect a seller to be willing to finance up to 30% of the deal. In this case, the seller will only agree to lend us 25%. This would equal $62,500 in vendor financing. In businesses with very little capital equipment, I've seen vendor notes as high as 70% of the purchase price. So let's recap. We're buying a business for $250,000 and we're borrowing $115,000 from the bank and $62,500 from the seller. We still need to find another $72,500. The other thing that we need to know is that the banker has said that they need to see something called an opening balance sheet with a debt to equity ratio of at least 3-to-1. What does this mean? It means that for every $3 of debt, we need to have $1 of equity. So basically 25% of the purchase price needs to come from you. And this can be from one of several different sources. It can be from the mortgage, it can be from your savings, it can be gift money, etc. So let's say that you have some savings and you put a second mortgage on your house to raise the 25% of the purchase. This is another $62,500. So now we're exactly $10,000 short of finding all the money that we're going to need to finance this business purchase. Where could we find this relatively small amount of money? From the business broker, of course. Let's learn why it might make sense.
To keep listening to this audiobook, I've left you a link in the description so you can do it at no cost thanks to Audible's 30-day free trial.